Thank you so much for joining us. And for our listeners, I mean, I generally begin by introducing our guest, but I think Nooresh sir को introduction की कोई दूर दूर तक जरूरत नहीं है. He's of course very famous, very popular. He's a technical analyst, and his analyst is, I guess, respected by मतलब entire India. Is all I can say. Uh, सर हम लोगों का आज का आई गेस थोड़ा सा जनरल ब्रॉडर एजेंडा आई थिंक विल love to know what is your view on the markets right now,
Okay.
and maybe what sectors you're kind of watching right now. If you have a watch list for stocks, maybe of course none of this would be a recommendation, like always. But we'll try to learn how to deal with such markets and general advice from you regarding these markets.
Okay. So,
Right.
to start off with, the standard disclosure, any stocks which we discuss, you can assume at times I could have a position on it. And also, it is not to be considered as a recommendation. Please do your own research and consult with your investment advisor, analyst, etc. So, I'll start off with the view on the market. So, uh, we are in the extreme short term. If you look at it, we are in a box, we are in a range wherein we've just made a low at 15,700 odd, and on the upper end, 16,800 is the upper parameter. So, this is the zone which we expect to hold for some time. And structurally, we've started a lower top, lower bottom formation on the index. That does not imply a bear market. When I say bear market, it's not just about 20%. Say, go back to the history, the bear markets in 1992, 2000, 2008, they were a drop of 50-60%. Then we've had a bear market wherein in COVID times we fell by around 30 to 40% on the benchmark index. And we've fallen 25% back in 2011, 2015, 16, and 2018. 2018, it was more on the broader markets rather than on the index. So I would expect a 20-25% correction from the top would be normal. So say a 14,000 to 15,500 band. If you look at a longer term say cycle, and generally it has been over the last 10 post 2009, the corrections have lasted for roughly around 1 year to 1 year to three couple of months. So in that case, we've already spent quite a few months right now. So we are right at the end of it in terms of if you were to compare it to the previous bear market. So somebody can have a view of 14,000 to 15,500. Uh, say, I would be watching out for more price action to confirm rather than say call a bottom right now or call another fall. But right now, this is something which is digestible as a long-term investor. As a short-term trader, these are times where you can't trade a lot because you're in a range. And in a range, it is tough to trade because you'll see, I call it a seesaw wherein one day up, one day down. But in the end, you're at the in the same park at the same place.
Right. And so, do you see any sectoral movement happening in these, at least sectoral rotations happening during this movement that is going on?
So the big sectoral shift which is there is first is what happened post COVID is say IT, which was always a slow and steady sector, never a sector which took the leadership. So say from pre-COVID to today, which is the best performing sector, it is the IT sector, even after the current fall. So if you were to look at the Nifty IT with the Nifty ratio chart, it broke out sometime in 2020 after 10 years, and that did really well. Now that sectoral rotation is over. Now, got to remember, these are sectors which can go for really long periods of time, where some of the big names may not come back to the same price. If we go back to 2012 to 15, that was the period of time where we first had a bear market, then the initial recovery, and in that we saw pharma take leadership. Uh, Till today, after the top in 2015, a lot of pharma stocks have not reclaimed back those highs. Some of them have done really well, but a lot of them, like the largest one, Sun Pharma, is still 20% lower than those prices even after 7 years. You have Dr. Reddy's, which is still struggling. You had DV Lab, which struggled a lot and recovered well. So when such re-rating gets over, there is a time where one needs to be careful that it could take a long time for the sector to take leadership again. So IT is a place where I'll be more cautious. Same is the case with all COVID beneficiaries. It's very interesting if you pick up a chart of a Metropolis or Dr. Lal Path Lab. you could actually point out the day when cases topped out in Mumbai and other metro cities. That is the day these stocks actually topped out. Since then, there have been a correction. So the reality is we are in the post-COVID world. That is what the market is telling you. So if you look at the big beneficiaries, it was IT, pharma, and some select names. Then which were the ones which got hurt the most? So it was first with all opening up names. It was say all hospitality, hotels as a business. Then second was banking. Now, if you look at banking, Bank Nifty is today at 35,000 roughly, is not even 10% higher than pre-COVID prices. But if you look at, say, the Nifty from a high of 12,400, we are still at 16,300, 500. So it has done much better. So if whenever there is a recovery, the leadership should come from banking as a space, large cap banking, it could be mid cap. If you look at the mid cap and the small cap banking name, a stock like City Union Bank, which is still okay uh, in terms of no nothing like a rumors around what happened with Yes Bank or a RBL Bank, etc. That is also down 40% to 30% from the top. A DCB Bank is down big time. IDFC First Bank is down big time. So this is where the opportunities will be. So this is where I would be watching out for. Second is autos as a sector did really bad initially. Then they started recovering, and then we got another wave. And then we got Russia-Ukraine crisis. So that is where the next rotation is. And the opening up theme, which is hotels, uh, casinos, theaters, etc., continue to look interesting on sharp decline. So banking, auto, and opening up theme is something which is on the radar.
Right. And so, is there something that you see in the small cap to large cap sector as well? Is it some? I have that feeling that maybe large cap companies are moving more right now compared to small cap and mid cap.
So this generally keeps on happening. So if you were to look at it in the whole of 2015 to 16, say the current market could be very similar to 2015, 16 or 2004 correction or a 2006 correction, in which you will initially see small cap do bad, but over a period of time, say if you look at 2015 to 16, we had a sharp recovery multiple times in the small cap index. Even today, if you look at the small cap index, we saw a solid recovery in March, April itself. So at one point of time, the small cap, the BSE small cap index was equivalent to the prices of October 2021. So October 2021, the small BSE small cap index topped out at 30,400, which is where the Nifty topped. Although the BSE small cap index made a new high back in January 2022 as well. So it was 30,500 to 31,500. And in April, we went up to 30,000 as such. And we are still above the March lows. Couple of attempts happened around those areas, and we are still above the March lows for the BSE small cap index. So I prefer looking at the BSE small cap index because it is an index which looks at the bottom 15% of the total market cap. So gives you the fair idea of how much fear or euphoria is there in the market. So this looks very similar to what happened in 2015-16. There will be select sector rotations happening in the small caps as well. So overall, this is a time where one should go hunting in the small caps, not buying stocks just because they're down 30, 40, 50%. You might be better off either by doing good research and understanding what is the next sector which is doing well, or buying companies which are actually closer to new 52-week highs instead of buying new 52-week lows in such time.
Right. That actually brings up a very interesting point. So I would love to know from you your view on this. There is a whole debate about value investing versus growth investing. So which side do you fall on, and which side will the markets prefer right now? Do you think?
So personally, for what I make investments, I'm an individual who generally finds it very difficult to understand a lot of growth investing because that is where you get hit in two ways. The first way is the price fall, which is okay because the prices fall for all stocks, right? The second way is a lot of growth stocks go into sideways period of really long periods of time where you can't justify that why is the stock down. It is just valuation derating. So, for example, if you were to pick up a stock, say Symphony, right? At one point of time, it was the talk of the town. The stock went up multiple times. There were stories about how you could have had a thousand bagger if you bought it in 2008, etc. But if you look at the price action for the last few years, the stock topped out back in 2015. It is still lower than 2015, and again topped out in 2018. So it's a 7 year period of no return. There was a time we kept on talking about Eicher Motors as growth, which still continues to be lower than the prices a few years back. So the second part is where I find it difficult to be a growth investor. Even when the company is doing well, the valuation de-rating could imply the stocks could go sideways for a long period of time, and that is the possibility which I'm looking at a lot of growth names. So it would be okay if say Asian Paints does not give any return for the next 3 years. It may not drop off 50-60%. So that is the second part which makes it a little more risky for me, because that is where I don't know whether to exit or to hold on. So I prefer looking at say one sectors which are cheap, and then those sectors making a technical breakout.
Right, right, sir. So for this market, given the current market scenario, which do you have any watch list currently going on? Maybe.
So say I'm looking into autos. So say for example, if I look at a Mahindra and Mahindra, so there were two phases to the stock. Initially, the stock did well from 2009 till 2017-18. Totally, if you look at it, but if you look at between 2015 to 2014 to 2018, it was relatively the worst performer, even though the largest stock in the sector, Escorts, was the one which performed well. So if you look at the prices in 2014, it was 700. So basically, in the last 6-8 years, it has come to 700 once at least, or gone below 700. So that's been the case. Finally, the stock after 4 years has made a new all-time high, crossed about that 950,000 mark. So this is a structural breakout. So say Mahindra and Mahindra looks interesting in the auto name. Similarly, one can look at banking names which look interesting. They're not 52-week highs, but a lot of stocks are in very tight ranges. So if you look at Axis Bank, the stock is available at the same prices as it was in 2014. So it topped out in 2014 at 650 levels. Then again at 650 levels back in 2016, the stock is still available at 650 rupees. So there are a lot of stocks in the large caps also which have gone nowhere for the last 7 years if you look at the returns. And those could be interesting because these companies have survived also. A lot of stocks in the same sectors have gone through a 50% correction and not come back. So banking, auto look very, very promising. In the mid cap and the small cap, say a lot of pipe companies which are more into oil, say what you call Welspun Corp and Maharashtra Seamless. These are two stocks which are closer to 52-week highs. So that comes up on our radar. A couple of fertilizer stocks like a Deepak Fertilizer comes up on our radar. A Sri Pushkar Chemical. So these are companies which come up on our radar. So the point is, right now, the best way to trade going forward over the next 3-6 months is to find stocks and sectors which are doing better than the index. Because once the Nifty bottoms out and starts taking a rally, the best performers of this cycle will do really well. Uh, an example is 2015 was the year, 2015-16 was the year where chemicals started doing well. And they've done well over the next few years also. So that is the view right now. So looking at auto ancillaries also, because autos are interesting. For example, automotive axles is close to a new 52-week high. A Jamna auto is there. So these are the spots which are there. Auto ancillaries also comes into that.
Right. This was the market scenario here right now, sir. Do you track any global cues as well, sir?
So if you look at the global markets currently right now, if you were to look at what is happening in the Dow Jones or in the S&P 500, I just posted it about on it few charts on Instagram about it. So they're all in a box. So if you look at Dow Jones, it is in a 1,000 pointer range. Similarly, you have a similar range in S&P 500. So the last 2 weeks, it's not just India which has been doing the flip flop. Global markets have also been doing that similar flip flop. So the markets are in a range. These recovered from the lows, but there are not many triggers to create a rally or a correction as of now, it seems. So all the bad news is known. We know about what could happen. RBI could raise interest rate further going forward. Fed will be doing so, etc. But we have absolutely no clue what can be the positive, and that is where surprises can also come.
Right, absolutely. That's one fear that I fail to understand, which find it difficult, sir. In fact, recently I came across a statistic where it was seen that in the last 15 years, whenever there was a long-term rate hike cycle, out of 9 times, only 3 times the market fell. So, and rest of the 6 times, market actually went up. So, despite the global doom and gloom that inflation is there and the rate hikes will be there, companies will slow down their expansion plans. Markets actually rose in that. And I think it was an NSE analysis of Nifty 50. So, do you have any thoughts on that, sir?
So we wrote about this when we were in March itself, wherein if you compare the March April itself, when you compare there are two ways you can compare. You can either compare RBI rate hike cycle and the Nifty. You can compare the Fed rate hike cycle and the Nifty. So some of the best returns have come in the rate hike cycle or in a rate sideways cycle. Actually, a rate cut in terms of if I look at purely on statistics, what happens when there is a rate cut, it is more scary. So the worst of the falls in a short period of time have happened when there have been rate cuts. So the other way to look at it is in the common sense, the basic common sense way is if you need a rate hike either to curb say the overwhelming demand or there is inflation due to multiple reasons. So many a times, most of the times we've seen this is the scenario where the things are so good that there is a need of a rate hike. So that is what we are looking at in the previous cycle. So the fact is, rate hike and the Nifty, the correlation is actually positive. It may or may not work out going forward also, but the rate cut is more scary. That is the way I would look at it.
Right, right. And so, in these times, do you think, in fact, this is a question one of our audiences has asked in the comments as well. Do you think in these times that the rate hikes has been done and inflation is there, so debt-free companies are especially attractive to look at right now?
So see, when you just look at debt free or with debt, that is just one factor to invest in. If a company with high debt is able to generate a return on equity much higher than the capital, the cost of capital, you are sitting on a much bigger upside than with a debt-free company which is not growing at all. So the most important part is whether the company is growing, able to manage the debt or not. So there are a lot of companies which are debt-free but have zero growth or negative growth. So you will end up losing money irrespective of that. It's just that it will give you a comfort that the company will not go bankrupt. But it's not necessary high debt is a bad thing. It's a bad thing for a company which is not able to pay up the interest.
Right, right, perfect, sir. Okay, another question so that one of our audiences asks is it time to fear or be greedy in the market? So मतलब काफी सारे discounted CMPs पे companies available हैं तो इस समय greedy होना चाहिए या fearful होना चाहिए? That's an interesting question.
So I'd say it is not always necessary to be greedy or fearful. At times, all you need to do is relax or stay calm. So the problem is we've not fallen like what we were in COVID. So we fell 30-40% very sharply. Even when before that the small caps and the mid caps were already down 30% from the 2018 tops. So we are not in that territory that you become a lot greedy, right? This is the time where you become extremely say resourceful. So this is not a period of time where you can just say in 2020, even after November 2020, even after Nifty made 12,400, a new all-time high, you could have bought anything and still be in the money. So even after this correction, 80 to 90% of the stocks are higher than what they were at in November 2020 or in mid of 2021. So we are not in that period where everything is cheap. We are not in euphoria, luckily, because we don't have companies which quoted, say, 20, 50, 100x sales, which happened in the US. There are not many story stocks. A few came up, got listed. So there is no froth as such. So this is a period of time where the way to make money is if you have researched the stock. The luck part which was there, you could have bought anything in 2020, 21 and you would have made money. This will not work out. So there is a good possibility the index recovers and your stock could be down 30%, and the index falls 10% and your stock could be up 40%. So this is the period of time where your returns will get decided by the research you've done, or you are able to just do nothing and relax, wait for the right time. So now is not the time to be fearful or greedy. This is the time to actually work harder because it is not going to be easy to make money.
Right, right. Perfect, sir. Uh, okay. Another question, sir. This is a stock specific question. You may, if you track it, it's great. Otherwise, you may choose to skip it. CA Varun Gupta, sir, from Jaipur, he has asked long term view on Strides Pharma.
Uh, so if you look at, say, I would look at a lot of charts purely from a technical perspective because I track very few companies fundamentally. So if you were to look at Strides Pharma, the trend has been terrible, right? And there is no point having a new long-term view on a stock which is uh, topped out and not ready to take any sort of recovery. The stock has fallen from 1,000 rupees to 300 rupees, right? Now, at this point of time, only way you can take a bet is if you understand the company. Because catching a falling knife implies there could be periods of time where the stock either recovers really well or just falls another 50% or goes nowhere. So we've seen a Walcott Pharma, which used to be a story, did nothing for the next 10 years. So Strides Pharma, whether it will recover well, it's a tough call. But the point is, in such falls, you need to be out. You can't be waiting for a 50, 60, 70% fall. At least at some point of time, you have to accept that something is wrong.
Right, right, sir. Another question, sir. Ranjan ji has asked about chemical stocks valuation
Hmm.
now. For example, Fine Organics.
Hmm. So there is one screener which I run, which I've tweeted also about companies where price to sales is more than 10, 12, 15x. Whenever that happens, if the company is not something which can scale sales at a really fast rate, these are places where there is no place for what you call disappointment. So if something goes wrong, say we've seen a lot of chemical companies go through sideways phases back in 2011 to 13 because there was some say pollution control board norm on Atul. It went nothing, did nothing for 1.5 years. So if your price to sales is 10, 12, 15x, you better have a really long-term horizon on the stock or study whether the company can do well. So I don't track Fine Organic, but I think it comes in that same screener for me. And the stock recently has made a sharp move. It would actually be a good time to reduce allocations here. A lot of chemical names, again, have gone through a 5, 7 year cycle of consistent outperformance. Now, what happens is after a big cycle of re rating, not all companies do well, but in the cycle, everything will do well. So between 2014, 15 to 2020, every chemical company has done well. Now you're seeing the differentiation. There are some chemical companies down 30, 40, 50%. Some have not done well in the last 3, 4 years. So I'll be extremely cautious because if you do not understand the sector, this is a sector which you are very well placed if you avoid it itself.
Right, right. Great, sir. Thank you so much for that. Okay, next question, sir. It's a pretty interesting question by Annie. Should we be doing SIPs or full investments with type stop losses in the equity assets? What is your outlook on bonds? So, two questions actually: SIP or full investments with type stop losses? Which one you prefer? And second is outlook on bonds.
So see, the first part is if you're doing a SIP, then stop losses don't make sense because what you're trying to do is you want stocks to fall or stay sideways till the time you want to accumulate or keep accumulating. So stop losses don't make sense in a SIP. Stop losses are when you're trading or investing with a horizon where you want to get out when the prices are just not making any sense. So somebody could have a 5% stop loss, somebody could have a 20% stop loss. right? So SIP and stop losses don't gel well together. So that's the first part. So SIP actually has the logic where you want to increase the SIP on the way down, ideally. So
Yeah, I think sir. The question is, she wants to know, do you prefer SIP or do you prefer stop losses?
so I prefer SIPs for people those who are really there for the long term. One, second, uh, those who are going to build up and those who do not have the time. The stop losses are for say, and on an investment portfolio. Unless after a stop loss you're going to 80% cash, if you're selling X, buying Y, you're always invested a good amount of your net worth. So stop losses matter a lot more in trading than in investing. So, so my view is, if you're trading, a stop loss is to save you from, say, for example, Strides Pharma goes from 1,000 rupees to 300 rupees. So the stop losses are to save you from such fatal errors in your portfolio. So my view is, trade with a stop loss, invest with an asset allocation strategy, wherein you have some asset allocation strategy which tells you when to increase equity, when to increase debt, when to increase cash.
Right, right, perfect, sir. And the second part, sir, is about bonds. I think to further expand this question, from my curiosity point of view, do you keep a certain allocation of your personal portfolio into bonds, and like what percentage of it may be, and what should a common retailer do in such a scenario? Should they increase their allocation in bonds right now, maybe, or what should the strategy be?
So see, I am a pure equity guy. I am generally leveraged instead of being on cash. So bonds do not come in the portfolio. So for me, bonds is something which I never look at.
Right, right, perfect, sir. Okay. Another question, sir, by Srini, sir. Between HDFC and ICICI, which is a better bet in the banking sector, right?
So I think both are good bets. It is just a relative choice which is there. So this choice was much better a year and a half back, where ICICI was breaking out of a multi-year sideways period. So if you look at ICICI Bank, the stock did nothing between say 2015 to 2021. The stock was available at the same prices when the rally started, and then it made a new 52-week high and all-time high back in 2021. So in terms of trends, ICICI is better. So purely from a technical perspective, ICICI is something which I call it a leader stock. So I would expect, if over a period of next 1 2 years, ICICI should do better than HDFC Bank. But in the interim, just because HDFC Bank is available at the same prices as it was for the last few years, in the next short term, it is tough to call which one would do better. But structurally, I would go with ICICI Access as the leader stocks going forward. So if you look at pre-COVID, HDFC was also 1300. We are still at 1300, 1400 for HDFC Bank. So in the short term, there could be a catch-up trade, but structurally, if I were to go, it would be ICICI Axis and SBI in the banking, large cap banking space.
Right, right. सर नादिर सर ने एक फॉलोअप क्वेश्चन पूछा है कि शुड फंडामेंटली या आई गेस लॉन्ग टर्म में अगर आप कुछ स्टॉक्स को फॉलो कर रहे हो, उनको इन्वेस्ट कर रहे हो, उसमें डू यू हैव स्टॉप लॉसेस?
So I don't understand, just because you're holding a stock for long term makes you a fundamental investor. The point is, if you are a fundamental investor and you're talking about stop losses, you need to ask yourself whether you've done your analysis in the first place. We can keep saying XYZ company is great fundamentally, but whether it is in a good cycle, whether it is a valuation is okay, whether there is margin of safety, etc. So the point is, stop losses, like I said, is to stop you when a price falls down beyond a point, because you have no clue what the company does in a big way and you want to de-risk. So in the same way, in an investment, stop losses where the thesis goes wrong. So you might have bought it stock at 100 and your stop losses could get triggered at 160 when suddenly the thesis, the logic which you've bought for the company has changed, right? So the stop loss in a fundamental strategy in a long term is what is changing and what is good or bad for the company. So same way, the most important criteria for a technical trader is price. So you can say as a fundamental investors, it could be earnings or valuation. So you need to be taking a call on those bases rather than just a price stop loss. You take a price stop loss if you've not researched the company, if you don't understand.
Right. Perfect, sir. ओके सपना एम जी ने कुछ क्वेश्चंस पूछे हैं सर मोस्टली ग्रुप्स को लेके वन इज टाटा ग्रुप ऑफ स्टॉक्स ने काफी अच्छे रिटर्न्स दिए हैं पोस्ट कोविड सो कैन वी कंटिन्यू टू ऐड मोर इन द करंट टाइम्स एंड सेकंड इज डिफेंस रिलेटेड स्टॉक्स पे आपका क्या व्यू है फॉर द नेक्स्ट 4-5 years मे बी
So starting with Tata Group stocks, one has to remember that uh, Tata Group has companies in various sectors. So you just can't be buying a stock because it's a Tata Group company, right? So that is the first part. Second part is there are many micro cap, small cap companies which suddenly went up because they were Tata Group. So I remember seeing a stock called Automotive Stamping go up. A Tata Tele went up crazily. So you have to be careful in the second part as well. So look at uh, what is the company. Don't buy it just because it's a Tata Group company. So you can't be making money when the cycle is bad for the sector just because it's a Tata Group company. So yes, there has been a huge re-rating in Tata Group company. So better focus on each stock individually, not to take it as a call on Tata Group. And if you want to do it, there is a simple vehicle to play, which is Tata Investment Corporation.
राइट ग्रेट सर okay, next, Nadir sir ने पूछा है which sector is will be good and which sector to avoid. I think we've already covered that, Nadir sir, and we'll release a recording of this podcast immediately after it's over, so you can listen to that. Okay. Next, sir, if you track any of these, BAC, CDSL, and CAMS, if you track any of these.
So I do track BSC. So this is a stock which went from being a cash bargain to a highly valued stock in less than 2 years. I actually wrote an article back in 2020 April. Five stocks contrarian bet, which is where BSC was available at 280 bucks. And I think the holding in CDSL, etc., it was a bargain in a big way. Now it has gone through a big cycle. The story is well known. Indian equity participation is going great, etc., etc. But right now, one needs to have a much longer term outlook to be invested in BSC and CDSL. So you need to have a little more longer term outlook in BSC and CDSL and CAMS. In the near term, the story has played out really well. So I'll be interested in the stock if one has a little longer term view.
All right, awesome, sir. Next, sir, Agita ji ने पूछा है massive rally in oil India makes it a multi-bagger in 1 year. Should we consider it as a buy in now?
So technically, I have a positive bias. I recommended the stock 2-3 days back. Uh, the reason is very simple. If you look at the stock price, it used to be 260 back in 2012 when it got listed. The highest price till now is 330 rupees. The stock has done nothing over the last 10 years. And because of crude, all companies which are in the oil and gas pack have done well across the world. It's not just India which it has done well. At the same time, ONGC, which is the other company in the sector, has not given a clean breakout. It is still struggling. Oil India clearly in the last 3 days has broken about the 250-260 mark. Volumes are almost 3x to 5x the general volume. So technically, it's a big breakout. It's a big cup and handle breakout for the last 4 years. I would keep a stop loss below that breakout days low around 250 level, and initially a target price of 350, and then trail it on as it goes. So technically positive on the stock, not a buyer at 300, but any dip to 270 to 280 would be looking at a buy again with a stop loss at 250. If you own the stock, it's a hold. Keep trailing it. The price points to watch out for is 330, 350, and then trail on beyond it. So technically, a big breakout. Ideally, the target should be much higher.
Right. Great, sir. Okay, next, sir, विमल जी ने क्वेश्चन पूछा है कि मीडियम टू लॉन्ग टर्म के लिए which indicators do you prefer?
So, say I look at more price patterns rather than indicators. So, I prefer stocks which are making multi-year range breakout. So, like taking an example for Mahindra and Mahindra, or a very old example, say HUL, which did nothing for 10 years between 2000. 2002 to 2012, or Reliance, which did nothing between 2008 to 2017. So these are the kind of charts I'm generally on lookout for the longer term investment. Something which has gone through a 3, 5, 7 year, 10 years also of sideways consolidation and is breaking out with big volume. So cup and handle pattern is one. So that is one. And second could be the total opposite of it, where it has fallen a lot and is recovering in a big way.
Right. Right. Great, sir. Okay. Next, sir, a question I have JSW pay, JSW energy pay if you track it.
So the point here is JSW Energy for one part. So we actually, so this is a sector which nobody was interested a year and a half back. So we actually covered this sector back in 2020, uh, saying 2020-21, or rather in the start of 2021. And there was zero interest in Tata Power, JSW Energy. When we came out with the note, JSW Energy was 110 rupees, Tata Power was 60 to 80 rupees. So this was again, like I said, a sector which has done nothing for a long period of time, and that breaks out. So that is the point of time you want to look at them. So I very well remember JSW Energy used to be 100, back at the time when it got listed in 2008 to 2010 period. Did nothing for the next 10 years and then made the big move. So you want to be participating then, not at the current uh, prices where it has gone up from 100 to 400 and then gone sideways. Technically, in the near term, it seems to have topped out, could go sideways. Still, power is a sector because which something which has come out of 10 years may not just top out in a year. So, could be a stock if you like the company fundamentally, you can buy it here. But the good meteor part of the trade got over back in uh, last year itself.
Right. Right. Great, sir. Sir, reality sector पे what is your view currently? भावेश सर जाना चाहते
So,
हैं.
this is a sector where we went wrong in a big way. So, in a big way, as in, we expected the sector to break out. It broke out, did the first initial move, and we are back below the entry prices or lower in some cases. So, for example, if we were to look at it, a lot of stocks made 10, 12-year breakouts. And then, post the Russia Ukraine crisis, the rate hike cycle, etc., that has coincided in the way the sector has started correcting. So, the problem here is the whole momentum got taken out. So, for example, if you look at the largest name which has been around, which is DLF, which broke out about the 330 mark, went to 450, and we are back to 330 out here. That is what has happened in a lot of real estate stocks. Structurally, say because it's a breakout which happened after 10, 12 years, the next leg could play out in a lot of them. But for now, if one has a longer term view, you can go selectively in a lot of mid cap, small cap names. So something like a Colte Patil is very interesting. There is Soba Realty. There are multiple names in the real estate basket, but it will uh, be a sector which will first give you pain before it gives you any gain. And one has to be cautious because this is not the sector which has the cleanest companies as such. So more important is to look out for companies which have been around for longer. So in this view, we went wrong because the momentum did not stick as we expected it to be. So overall, they've not fallen as much from the entry pricing. But if one has a view out here, one will have to keep a lot of patience.
Right. 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 Great, sir. Sir, Sandesh Mane sir का बड़ा interesting question है. Uh, is there any strategy to trade the stocks for medium term in this market scenario? Do conventional methods of breakout still work? Could we see many don't work due to strategies in such volatile markets?
So see, the first part is one has to realize is that whether it is breakout, breakdown, any sort of technical strategy will have periods of time where it will not work. And we know it that we are not going to be right 80, 100% of the time. So I have a very simple thing. If our, say, performance is 80% hit ratio, it is not that we are right or we are doing something great. It is the market which is right. It is in a trend. So in a trend, breakouts will do great. In a sideways market, not all breakouts will work. Say in a good market, 80% of the breakouts will work. in a trending market like 2020, 21. In a market like 2022, maybe 40%, 50% will work. But the point is, if you have taken a strategy which is to focus on breakout, all you want to do is keep playing that out because, say, something which breaks out. So, for example, one of the trades which I recently missed called a company called Elecon Engineering. The stock broke out. The markets were sulking. The stock has gone up 30% in the last 7 sessions, right? So, you don't know, similar chart somewhere else has done nothing after the breakout. So, the point is, in such period of time, it may not work, but your risk rewards are in place. So whichever works, say maybe you go wrong, you lose 6-8%. One of them goes right, you'll make 30%. Net, in a sideways market, you'll not lose a lot of money if you're trading breakout. A lot of money in the sense that because some of the breakouts will definitely work and they'll do really well. So the stocks which break out in a sideways market, they do really, really well. And that can do wonders to your portfolio because anyways the markets are going nowhere. So the point is, if you're a breakout trader, stick to those breakouts even in the sideways market. You want to stop trading them when there is no breakout. So say between April, May, June, from May, there were hardly any breakouts. There were no trades as such.
Right, right, right. Great, sir. Okay, so we have three more company stock specific views if you track them. South Indian Bank or Karur Vyas Bank and HUL.
So again, South India Bank, Karur Vysya Bank, these are stocks which have fallen a lot over the last, ever since topping out in Jan 21. Some have topped out a bit later. So technically, I would buy them at the recent swing highs being crossed. Till that point of time, have zero view because many of these banks will never cross them. Some of them will do, and they'll be the leader. So, for example, if I pick up a South India Bank, I'll buy it at say 9.5, 10 rupees, not at 8 rupees. And HUL, another stock which uh, I would be a little skeptical on because this was also a beneficiary, the first beneficiary of the COVID crisis. The first stocks to actually hit 52-week highs were the names in FMCG, and since then they've gone nowhere. So you can pick up a Nestle, we are at 17, 18,000. You can pick up a HUL, you're at 2,300. You can pick up a Britannia, you're still at 3,500, where we were in July 2020. So in a stock or a sector which has gone nowhere for the last 2 years, won't really be interested. So would avoid HUL at current level.
Right. So two more stocks, Poonawalla Corp and MOL. Do you track any of these?
So I'll be very skeptical in both the names in terms of not about the entry, but skeptical in terms of exits. So one has to keep fixed stop losses at the last swing low because both these stocks have gone up for multiple different reasons. So Poonawalla has gone up after the name being changed and the promoters being changed. And since then, the stock has gone up almost 2.5, 3x. Uh, Maybe the fundamentals, if you look at earnings, they've not caught up in the same way. So in this case, one needs to have a view wherein either you will stick longer term, you are very focused on the story. So I'll be very cautious in this in terms of keeping a stop loss say at 200, which was the recent low, 200 to 15, and then ride it on. So in such cases, you want to either get out if the thesis changes or the price changes. MOL, I have a lot of concerns on the actions of the management which they've done before. So out here, it is very simple. Take a stop loss based strategy, even if you like the stock fundamentals.
Right. Great sir. So क्वेश्चन तो हमारे पास बहुत सारे आ रहे हैं बट हमारा टाइम लिमिटेशन का भी एक इशू है सो बिफोर वी लीव आई रियली वांटेड टू नो वन थिंग recently you created a post and I absolutely loved it which was जो इंडियन स्टॉक मार्केट में यूनिवर्स है उसके 5 डिविजन्स आपने बताए
Hmm.
so sir could you repeat that I would love to understand it on the spaces as well.
So what happens is we generally keep listening everyone talking about there are 5,000 stocks in India. There are so many choices. How will you choose, etc. But the reality is that used to be 5,000 stocks. Out of them, say 3,500 say trade on the markets. Around 1,500 of them are useless. because they have sub 100 crore market cap. Then you have 2000 stocks which really have a market cap of more than 100 crore, which is where you want to participate. You can't be participating in a 20 crore market cap companies, etc. So then you go to companies, there are say roughly 700 companies which are between say 100 to 500 crores of market cap. Then there are 300 companies between 500 to 1000 crores market cap, and then the whole universe of more than 1000 crores market cap. So the reality is there are just 1000 companies which are available for institutions, HNIs, etc., to be traded regularly. So the universe is not as huge as people consider it to be. So you have a lot of opportunity in this band of 100 to this 1000 companies which are there between 100 to 1000 crore. So that is the reality. So there are not 5000 stocks which you can actually, uh, and in that, if you run a few screeners, for example, if I speak to a fund manager who's on the mutual fund side, his universe could be say 200 to 300 stocks. You speak to a PMS fund manager who has some sort of screening. Again, the universe is not more than 300, 500 stocks. So in the same way, the universe is not huge, but the point is if you find a great company, the float available is very low in India. So there is always a scarcity premium when the things go great. So a lot of stocks, which I call pittal, become gold. So brass gets valued at gold, and at times brass turns into gold in India. So I prefer to look in that small cap to mid cap category a lot, not in the micro cap category. Right. Perfect.
Right.
Great, sir.
Perfect. Great, sir.
Sir, before we
Sir, before
finally
we
bid
finally
goodbye
bid
and say
goodbye
thanks to
and say
you,
thanks to
can we
you,
have
can
one
we have
last
one
quick
last
concluding
quick
remark from
concluding
you,
remark
one
from
quick
you, one
advice
quick
maybe for
advice maybe
everybody
for
out there?
everybody out here?
So, I tell people what I've seen in the last couple of years is, which is what happens. And this is where a lot of people get into the market. So, for example, I got into the markets back in 2004-5, got full time in 2007. So initially, everyone gets into the market because everyone is having a great time, or you have a lot of time. So I got into markets because I had a lot of time during my second year of engineering. So in the same way, in 2020, 2007, a lot of people came into the markets because their neighbors were making money, their friends were making money, so everyone wanted to participate. Same way, a lot of people have started coming into the market in 2020 to 2022. That was the luckiest time to be in the market because the markets had fallen for reasons which were, say, not in the control of Jaws or anyone else. So we did not see a pandemic based fall in the last 100 years in a big way. So that was one. Second, suddenly you had a lot of time and everybody had savings. And then you had a time where uh, starting to invest was very simple. You could open an account really fast. You could transfer money really fast. This was not the case in the previous cycle. So you got the trifecta of all this time, money, and ease together in 2020, and we had a great markets after that. So because of that, suddenly everyone thinks we all can become investors and traders. A lot of people want to quit their jobs to become full-time traders because they hate their job. So do not become a full-time trader or an investor because you hate your job. And the last 2 years were superb. You've got a great start if you started in the last 2 years or increased your allocations to equities in the last 2 years because you got a superb start. Market does not give such a start and a sticky start right away. So if you're sitting on a century, right now is the time where you make it a point that you played conservatively, learn more, stick around a lot more rather than becoming aggressive. So this is the point of time where you actually want to start improving your skill sets because making money from here on cannot be just luck. You need to have some bit of skills. So in 2020, we did a random portfolio test. Even today, when we did it, you could have bought anything in March 20 and your portfolio would be up 3x to 5x. Right. So this does not happen often and it does not come on a platter every time. So right now is the time. If you are a guy who's new or who's become more active in the last 2 years, please go back, research, learn technicals, learn fundamentals, learn everything about the markets, get your investment philosophy, trading psychology, everything in place, Because going forward, that will be needed. It will not be an easy ride as it was in the last few years.
Right, right.
Great, sir. Thank
Great,
you
sir.
so much
Thank you
for
so
that.
much for that.
This was
This was
amazing. This was such a
amazing. This was
brilliant
such a
session. I don't
brilliant
know
session.
how
I don't
time
know how
breezed by.
time breezed by.
But still, sir,
But
thank you
still,
so
sir,
much for
thank you
making
so
up
much
time
for
for
making
us.
up
I
time
really
for
can't
us. I
thank you
really
enough for
can't
it,
thank you
sir.
enough for it, sir.
Thank you so much.